Hey everyone, and welcome back to the Violet Vault. I'm so glad you're here today because we're going to tackle a really big topic, one that feels almost like a force of nature in the financial world: market bubbles. You know what I'm talking about. Those crazy, wild times when it seems like prices for something, anything, just defy gravity and shoot for the moon, only to come crashing back down to earth. It feels like a story that repeats over and over again. But here's the thing. What if it's not random? What if there's a predictable, very human psychology behind all the madness? Well, that's what we're going to unpack today. So, let's start with the big, scary question, right? Why do markets crash? This is the one that keeps people up at night, that creates all the fear and anxiety around investing. But here's the secret. To really understand the crash, you first have to understand the bubble that comes right before it. The crash isn't the beginning of the story, it's the inevitable end. And this pattern is definitely not a new thing. I mean, it's been echoing through history for centuries. We're talking about tulip mania in the 1600s, where a single tulip bulb could cost more than a house. Then you have the roaring 20s leading up to the Great Crash of 1929. Fast forward to our lifetime, the dot-com bust in 2000, the housing crisis in 2008, and even the more recent crypto winters. The assets change, right? Tulips, stocks, websites, crypto. But the human emotions driving the frenzy, the script is almost identical. These aren't just a bunch of separate, unlucky events. They are the same story, just told in different languages across time. Okay, so let's start pulling back the curtain on this market madness. Because it turns out what looks like total chaos from the outside actually follows a surprisingly predictable pattern. You can almost map it out. It's like this recurring dream of getting rich quick that, unfortunately, so often turns into a collective nightmare. And this is absolutely crucial to understand. Market bubbles are not accidents. They aren't just random economic blips. At their core, they are psychological events. They're fueled by powerful stories that we tell ourselves and each other. You know the kind of story. This new technology is going to change the world. Or, this is a whole new kind of asset. The old rules don't apply. And once enough people start believing that story, it becomes a self-fulfilling prophecy. For a while anyway. We collectively create the reality we want to see. So, how does this story actually unfold? How does a perfectly calm, sensible market slowly transform into a dangerously unstable one? Let's get into the step-by-step anatomy of how a bubble inflates. This quote from an economist named Hyman Minsky just nails it perfectly. Stability breeds instability. It's a paradox, right? But think about it. It's when things feel the safest, when the economy seems strong, people are making money, and everyone is optimistic, that we start to let our guard down. We start taking on more and more risk. That very feeling of comfort is what plants the seeds of the next crisis. It's like we completely forget the feeling of getting burned, so we start inching closer and closer to the fire. Minsky actually broke down this growing risk into 3 stages. First up, you've got hedge finance. This is the safe, boring stage. You borrow money, and your income easily covers both the loan itself, the principal, and the interest. Everyone's happy. But then, things get a little hotter. We move to speculative finance. Now people are borrowing so much that their income can only cover the interest payments. They're just treading water, betting that the value of whatever they bought will keep going up. And finally, we hit the red zone, Ponzi finance. This is where it gets really scary. At this point, the cash flow doesn't even cover the interest. The only way to survive is for the asset price to keep soaring so you can sell it to the next person for a profit. The whole system is no longer running on fundamentals, it's running on pure, unfiltered belief. So that's the mechanics of it. But what's the emotional engine that's pushing us from that safe stage all the way to the danger zone? Well, it really boils down to 2 incredibly powerful psychological forces that are just pouring gasoline on the fire. First, there's overconfidence. This is that little voice in our head that says, yeah, but I know better, or the old rules don't apply anymore. It's summed up by the 4 most dangerous words in investing. This time, it's different. And right alongside that, you have its partner in crime, hurting behavior. We all know this one today as FOMO, right? The fear of missing out. You see your friends, your neighbors, people on social media getting rich, and all logic just flies out the window. The primal fear of being the only one left behind becomes way stronger than the rational fear of losing your money. And this is where the entire mindset just flips on its head. A rational investor is supposed to ask, okay, what is this thing actually worth? What are the fundamentals? But in a bubble, the herd asks a totally different question. What is everyone else doing? Price momentum becomes the only thing that matters. The decisions of others become the proof, and the actual value of the asset gets completely lost in the noise. Now check out this quote from the famous economist John Maynard Keynes. This really gets to the heart of why even really smart professional money managers get swept up in the herd. It's basically a social survival instinct. Think about it. If you're wrong, but everyone else is also wrong, you can just shrug and say, hey, the whole market went down. But if you bet against the crowd and you're wrong, you look like a complete idiot. It's actually safer for your reputation and your career to fail with everyone else. It's a wild thought, isn't it?
You know how it goes. Every party has to end. At some point, a crack appears in the story. Confidence starts to waver. Maybe a big player sells or some bad news comes out. And suddenly, someone decides to head for the exit. This is that moment. This is when the music stops. This chart of the S&P 500 really says it all without any words. You can see it so clearly. Every single one of those euphoric peaks, whether it's the dot-com bubble or the housing bubble, is eventually followed by a sharp, painful drop. Gravity always wins in the end. The pop isn't a question of if, it is always a question of when. And when that bubble finally does pop, the damage doesn't stay in one place. It spreads through something called financial contagion. In our modern, interconnected world, a crisis that starts in one little corner of the market, like with US subprime mortgages back in 2008, can rapidly infect the entire global financial system. Panic becomes a virus, spreading from bank to bank, from country to country. Now, it's really easy to look at all of this and just see pure destruction and pain. But here's where it gets a little more nuanced, and I think really interesting. In the wreckage of a crash, sometimes you find the foundations of the future. It turns out, not all bubbles are created equal. We can basically think about them in two different categories. On one hand, you have mean reversion bubbles. These are just fads. The price shoots up, it crashes back down, and nothing has fundamentally changed, except that a lot of people lost a lot of money. The 2008 housing crisis is a great example of this. But then you have what are called inflection bubbles, and these are different. The mania, the hype, the overinvestment, while it's still painful when it crashes, it actually ends up building the infrastructure for a real technological revolution. So one leaves behind only wreckage, while the other leaves something real and valuable behind. The dot-com bubble is the perfect case study for this. The crash itself was absolutely brutal, no question. But all of that wasted money from investors, it funded a massive worldwide build-out of fiber optic cables and server farms. It was that infrastructure built during the frenzy that literally paved the way for the high-speed internet we use every single day, for social media, for streaming movies, for watching this right now. It's a kind of creative destruction. So after all this, what's the big takeaway for you? What can you actually do with this information? Well, the goal isn't to become some kind of fortune teller who can perfectly predict the top or bottom of the next market cycle. Honestly, that's a fool's errand. The real wisdom, the real power, is in learning to recognize these timeless patterns of human behavior when they start to appear. It's about understanding the stories the market is telling, and this is the most important part, being brutally honest about the story you're telling yourself. Because that right there is the bottom line. The specific technologies will always change. It was railroads once, then radio, then the internet, maybe it's AI today. But the underlying human psychology, that potent mix of greed, fear, overconfidence, and our deep-seated need to follow the herd, that part doesn't change. It's wired into us. So the real question I want to leave you with is this. Now that you've seen the pattern, will you recognize the signs next time? I hope this was helpful. Let me know in the comments. Have you ever felt the pull of FOMO during a market frenzy? I'd love to hear your story. And as always, if you got value out of this, a like and subscribe would mean the world.
Wow, that was something, right? But don't go anywhere, there's more coming, and it's gonna make you think in a whole new way. Quick reminder, if you like learning cool stuff without the fluff, subscribe now. You won't regret it.
Okay, just look at this number for a second. $42 billion. It's one of those numbers that's so big, it almost doesn't feel real. But here's the thing. It is very, very real. That's how much money was pulled out of just one bank, Silicon Valley Bank, in a single 24-hour window back in March of 2023. An absolutely staggering amount that caused the bank to completely collapse. And believe me, it sent a shockwave through the entire financial system. You see, what happened there wasn't the kind of bank run you see in old movies. It was something entirely new, way faster, and honestly, a lot scarier. Today, we're diving into the story of the digital bank run and how the phone in your hand has completely rewritten the rules of money and panic. So here's our game plan. We're going to talk about what this new digital bank run really is. Then we'll peek behind the curtain at how your bank actually works. We'll take a quick trip back in time to see how we've dealt with panic before. Then we'll get into the real heart of it, how speed and social media changed everything. And finally, we'll talk about what we can actually do to fix it. Right, so when I say bank run, you probably picture those black and white photos from the Great Depression, right? Crowds of people lining up for blocks, all trying to get their life savings out. Well, the SVB collapse looked nothing like that. It was silent. It happened in an instant, through millions of invisible clicks on phones and laptops. A totally new kind of panic. And that just begs the question, doesn't it? How on earth can a bank, the one place we trust to keep our money safe, just run out of it? Well, to get that, we need to pop the hood and see how the whole modern banking system is actually built. It all comes down to this idea called fractional reserve banking. Now, that sounds complicated, I know, but the concept is pretty simple. And it's not some sneaky trick. It's what has powered our economy for centuries. It basically means that when you deposit money, the bank doesn't just let it sit in a vault collecting dust. They keep a small piece of it, a fraction, on hand, and they lend out the rest. Let me give you a quick example. Let's say you deposit $1,000. The bank might hold on to $100, just in case, and then lend out the other $900 to, say, someone starting a new coffee shop. That person then uses the $900 to buy an espresso machine, and the company that sold it deposits that money into their bank. And just like that, your original deposit helped create more money in the system, funding everything from home loans to small businesses. It's pretty cool, right? But, and this is a huge but, there's a catch. The whole system has an Achilles heel. It works beautifully as long as we don't all ask for our money back at the same time. You see, the bank's money isn't liquid cash. It's out there in the world as 30-year mortgages and 5-year business loans. So if everyone rushes for the exit at once, the bank literally doesn't have the physical cash to give them. And that, my friends, is when panic turns into a full-blown crisis. Okay, so this isn't exactly a new problem. This vulnerability has been around for as long as banks have. And because of that, we've actually built some really smart, really strong safety nets over the years, specifically designed to prevent these panics from ever starting. Think back to the Great Depression. It was chaos. Thousands of banks failed. So in 1933, the government stepped in and created a true game changer, the FDIC, the Federal Deposit Insurance Corporation. You've heard of it. It's that little sticker on the bank's door. It guarantees your money up to $250,000. And the whole point was to give you peace of mind, to make you so confident your money was safe that you'd never feel the need to run. And for almost 100 years, it worked perfectly. Until it didn't. And that leads us right to the big mystery of 2023. If we have this incredible safety net, the FDIC, why in the world did we see a bank run happen in our modern world? Well, the answer is that the game has completely changed. Our old protections were designed for an analog world of paper and people, and we are living in a digital world now. So the big question we have to ask is, why now? If our money is supposed to be safe, what was so different about this time? It turns out, our protections just weren't built for the incredible speed of today's world. Researchers have pointed to 3 things they call digital accelerants that basically threw gasoline on the fire. First, there's just the sheer speed. You can move millions of dollars with a tap, 24/7, no more waiting for Monday morning. Second, coordination. A single rumor on Twitter or in a private chat group can get thousands of people to pull their money at the exact same time. Fear can literally go viral. And third, and I think this one is fascinating, is the psychology of it. Clicking transfer on your phone feels easy, almost weightless. It's not like the heavy, real-world act of going to a bank and asking for a briefcase full of cash. So let's just put this side by side. An old-school bank run was like a slow leak. It was limited by how many people could physically get to the bank during business hours. A digital bank run? It's like a fire hose. It's instant, it's global, and it's fueled by viral panic. The scale is just on a whole other level. Okay, I know this all sounds pretty scary, but here's the hopeful part. What if the very same technology that makes all this possible could also be the key to preventing it? Let's talk about how we could, slow down this storm. So, can we actually use these powerful digital tools to create stability instead of chaos? The answer seems to be a cautious yes, but it means we have to start thinking about technology in a completely new way. There are two really promising ideas taking shape. First is using AI to predict these things. Imagine a system that can monitor social media chatter and transaction data to spot the early warning signs of a panic before it gets out of control. The second idea is a bit counterintuitive. It's about adding what experts call strategic friction, basically building in little speed bumps on purpose. Things like an extra security step or a mandatory 5-minute pause for withdrawals over a certain amount. The goal isn't to stop you, it's just to break that cycle of instant panic and give everyone a moment to breathe.
And really, that's the big question this leaves us with. For decades, we've been obsessed with making everything faster, easier, more frictionless. But maybe, just maybe, when it comes to our financial system, a little bit of friction isn't a bug, it's a feature. Maybe that tiny, deliberate pause is the price we pay for safety and stability. It's definitely something to think about. So let me know in the comments. What do you think? Is a little bit of digital friction a good idea? I'd love to hear your thoughts.
Wow, that was something, right? But don't go anywhere, there's more coming, and it's gonna make you think in a whole new way. Quick reminder, if you like learning cool stuff without the fluff, subscribe now. You won't regret it.
All right, welcome. Today, we are going to crack open the rulebook that was designed to stop another 2008-style financial meltdown from ever happening again. We're going to look at the tools, the tests, and the big trillion-dollar question that still hangs over all of us. Is the global economy really any safer today?
Let's just start with this powerful warning from Ben Bernanke, the man who was literally in the hot seat during the 2008 meltdown. The crisis left the world's top financial minds with this massive challenge. How in the world do you let a financial giant collapse without it taking the rest of us down with it? To really understand the solution, you first have to appreciate the terrifying scale of the problem. This was never just about saving one company. It was about stopping a financial virus from infecting the entire global economy. At the very heart of all of this is an idea called systemic risk. Now, the best way to think about it is like a line of dominoes, right? A huge bank isn't just one company. It's a critical piece connected to thousands of others. If that one big domino falls, the chain reaction can be absolutely devastating, freezing credit, wiping out savings, and just bringing the global economy to a screeching halt. And this isn't just some theory. We all saw this play out in real time back in 2008. It started with a flood of really risky home loans here in the US. Then, these loans were bundled up into these complicated products and sold to investors all over the world. So when the housing market finally imploded, those safe investments turned toxic. And that led to the shocking collapse of Lehman Brothers, which triggered a massive wave of panic across the entire financial world. And that's where we get that dreaded phrase, too big to fail. Regulators were just trapped. Letting these giants collapse was completely unthinkable because of that domino effect. But bailing them out with our taxpayer money, that created this huge public backlash and a really dangerous precedent for the future. The thing is, the safety net that was in place back then was designed for a much, much simpler financial world. It was totally unprepared for the kind of interconnected monsters that existed in the 21st century. Just look at the difference here. For a small community bank, there's a clear, routine process. The FDIC has a well-oiled machine for that. But for a global giant like Lehman Brothers, there was no plan. No playbook. It was like trying to put out a raging forest fire with a garden hose. The old system was just completely overwhelmed. So the crisis made it painfully clear that a new rulebook was desperately needed. In response, Congress passed something called the Dodd-Frank Act. It's a massive piece of legislation that was basically designed to create a doomsday plan for the next big crisis. Okay, so the first piece of this new puzzle is an early warning system called the FSOC. You can think of them like financial watchtowers, constantly scanning the horizon for the next big threat. And they can even label non-bank firms like a giant insurance company as systemically important, which pulls them under much stricter supervision. The second piece is basically a mandatory fire drill. Every single year, the biggest banks are forced to run these simulations of a catastrophic economic collapse. They have to prove, on paper, that their finances are strong enough to take that kind of hit and not fail. And if they can't, they are forced to raise more money immediately to shore up their defenses. But the real centerpiece of this whole new rulebook is what happens when all that prevention fails. It's a pre-planned, controlled demolition, a way to let a giant fail without it blowing up the whole system.
This is known as the Orderly Liquidation Authority. It's got a fancy name, but think of it like the financial world's bomb disposal squad. It gives the FDIC the power to step in and manage the failure of a massive firm to prevent a chaotic, Lehman-style explosion. And the goal here is super specific: no messy collapse and no taxpayer bailout.
So how does this controlled demolition actually work? It's a strategy called single point of entry. Instead of a total shutdown, regulators only seize the parent holding company at the very top. The critical customer-facing parts of the bank, the parts that you and I might interact with, they're kept running inside a temporary bridge company. Now here's the most important part. Shareholders get wiped out, and the big investors who lent the company money, they're forced to take the loss. The pain is felt by those who took the risk, not the taxpayer. Okay, so this all sounds pretty good in theory, right? A powerful, well-designed machine to prevent another 2008. But the real, multi-trillion-dollar question is, has it actually made the system any safer? Well, the reality is, it's complicated. Over the years, some of these rules have been relaxed a bit. For instance, by 2023, the number of banks that had to go through those tough stress tests we talked about had fallen by about a third compared to 2017. And that's raised some real concerns that the oversight was getting weaker. And then, in March of 2023, the system faced its biggest test yet. Silicon Valley Bank failed with, breathtaking speed, all fueled by a digital bank run. The panic started to spread, and to stop it, regulators did something pretty controversial. They used a systemic risk exception and guaranteed all deposits, even the huge ones well over the insurance limit. That decision brought back a really thorny old problem in finance called moral hazard. In simple terms, it's the idea that if you protect people from the consequences of their actions, well, they're just more likely to behave recklessly in the future. And as you can imagine, this move ignited a fierce debate. By stepping in to stop a wider crisis, did the government accidentally signal that too big to fail is still very much alive and well? Did it send a message that when the chips are down, there's always going to be a safety net, even for people who aren't technically insured? And that really leaves us with our final critical question. This new rulebook was designed to make shareholders and creditors pay the price of failure, not taxpayers. But in its first major test, regulators stepped in to protect everyone to prevent a panic. So is the system actually safer, or have we just created a more complicated, less predictable safety net? That's a question we should all be thinking about.
Thank you for spending time with us here at the Violet Vault. Don't forget to like, subscribe, and drop your thoughts in the comments below. I'd love to hear from you. Until next time, stay focused and keep growing.